One of the interesting things about this course is that you might have expected taking an Intro to Economics course that we would be talking about money the whole semester. And we sort of have in the way we talk about how people barter or exchange and how people how that exchange behavior leads to prices. But we really haven't focused in on money as a thing in itself. And here we are with just a couple weeks to go, chapter 14, and we finally get to money. So I think this is it's an interesting thing to say about how we talk about economics these days, but this chapter focuses on money and monetary institutions. In the next chapter 15, we'll talk more about sort of macroeconomic policy and about the sort of damage that money can do and the ways we might think about making sure that money doesn't do that damage. But in this chapter, it's about money. And hopefully you've had a chance to look at On the Origins of Money, or read the On the Origins of Money supplemental reading. I think that will be very useful for you to take a look at in addition to this talk. I want to start, though, this lecture by looking at what we mean by money today in the United States. Important thing to understand, of course, that the U.S. dollar is not redeemable in anything. They are pieces of paper issued by the Federal Reserve Bank, the Federal Reserve System. Technically, they're called banknotes. We'll talk a little bit more about the Fed in a few minutes. They are IOUs of the Federal Reserve System. They are, in that sense, they are liabilities of the Fed, and implicitly, and this is where it gets tricky, liabilities of the United States government. If you have a dollar, they owe you something. It's not clear exactly what it is that they owe you because you can't go in and redeem it for gold or for anything else for that matter. So the interesting question is, why do people use these pieces of paper as money? Now, if you've read the Salter piece on the origins of money, you probably have an idea about this. We accept them because we believe that others will accept them in exchange as well, right? So we take money, we hold money because we believe we can pass it on to the next person. What we mean by money is a generally accepted medium of exchange. And so this idea of general acceptance is important, right? You can have something that serves as money, but to really be money, it has to be the case that it's generally accepted, that you know that others will take it in exchange. If others won't take it in exchange, you're less likely to take it and the whole thing collapses. I'm not going to talk about things like Bitcoin, but you might think about Bitcoin here and whether or not Bitcoin is in fact money, precisely because of this question of whether it's generally accepted. There's other issues about Bitcoin involving whether it's truly a medium of exchange, but I'm going to leave those aside. I'm certainly happy to answer those in the Q&A and on the discussion forum if you wish. In general, everything we use as money is an IOU of a trusted institution. That's what enables it to be passed on. So if you think about the money in your checking account, right, as we'll talk about in a minute, that's an IOU from a trusted institution, namely a bank. So what is it that people, the public, use as money? Basically, there's two broad categories of things that they use as money. The first, what we've been talking about so far, of course, Federal Reserve notes, right? Those are the dollars that we have in our wallet. Here's my wallet, right? And here in my wallet, right, is a dollar bill. So these are Federal Reserve notes. They were at one time redeemable in gold. Again, as I said, not anymore. We accept them because we think other people will accept them. But most of our money, most of the transactions people engage in is done in terms of what we call demand deposits. Those demand deposits are the checking account dollars that you have. Those are substitutes for cash, for paper currency. Okay. Why are they called demand deposits? Because they are redeemable on demand in cash. You can go into your bank and say, I want to cash out my checking account. They are obliged to pay you cash for it. Interesting thing about demand deposits, they are liabilities of the particular bank that issued them. So, for example, if you have an account like I do at Chase, okay, the dollars in your checking account are a liability of Chase. And if you think about what your debit card is just another way of accessing your checking account. So here's my Chase debit card with the numbers covered up, right? And that Chase, what does that Chase debit card do? It just lets me access my checking account dollars whenever I feel like it, in a more convenient way than the old-fashioned sort of writing a check. The overwhelming quantity of exchanges in the U.S. economy take place using checking account dollars, at least 7 to 1. I think it's more like 8 to 1 or 9 to 1 now. It's also important to understand that when we spend those checking account dollars, writing a check or using your debit card, involves a clearing process between the two banks. So if I write you a check, or if I pay a merchant using my debit card, and they have an account in a different bank, somehow those two banks have to get together. The money has to come out of my account, my account and into the account at the other bank. And so one of the things we'll talk about is how that happens, how do banks clear to each other. And notice, right, both of these, all of this is IOUs of trusted institutions, and that's the important thing. Just as a sort of general point, we can think about how much money is out there in the economy. We have two basic measures of money that the book talks about. I'm not going to offer the definitions, they're there in the book, but M1, which is the very narrow one, basically the currency the public holds and demand deposits plus a few other things. Right now that totals 3.6, almost 3.7 trillion, that's with a T, trillion dollars in the U.S. economy in M1. M2, a little broader measure of the money supply, includes everything in M1 plus a whole bunch of other kinds of deposits that people have at banks, again, talked about in the textbook. M2 is currently, as of first week of April, M2 is $13.9 trillion. So that just gives you a sense for those things. When banks make loans to their customers, that expands, or M1, when those loans are paid back, that decreases M1. It's our preferences for different types of money that determine whether we hold M1 or M2. If we'd rather hold these other kinds of checking accounts, we go into M2. If we'd rather hold cash or standard checking accounts, that's M1. So how do banks create money? There's two key facts you have to understand how banks create money. First, banks are required by U.S. law to keep funds on deposit with the Federal Reserve System in order to clear those checks with other banks, right? So if I write you a check, right, your bank has to get money from my bank. How they do it is they go to the Fed takes money out of the account that my bank keeps at the Fed and transfers it to the account that your bank keeps at the Fed. Okay, so this is the fact that these banks all have these deposits at the Fed or other kinds of clearinghouses, right? Those organizations just transfer the money from one account to another when a check clears. The other thing to understand is that a bank's total reserves, that is all of the stuff that it keeps on hand, right, to make sure it has enough money on hand to pay off depositors when they come in, those are comprised of two things. First, those deposits at the Fed that we've been talking about, right, those accounts they keep at the Fed, and their holdings of what's called vault cash, which is basically dollar bills and coins that they keep in the bank. Those two things together are the foundation off of which banks create money. Because when you think about it for a second, right, think about all the checking account dollars that banks have. If people go to the bank and want to redeem those into cash, banks better have cash on hand, right? Or people start writing checks, write a big check, they better have money on deposit at the Fed to pay the other bank who receives that check. So one of the key things for banks to have to do is to make sure they have enough reserves on hand. So how do banks create money? Right? Well, suppose you go in the bank and want a loan. Okay, the bank, if it approves the loan, literally creates and credits your account for the amount of that loan. So suppose you borrow $5,000. The bank simply says, we are going to add $5,000 to your checking account or create a new checking account for the loan worth $5,000. The bank has said, we are creating a new liability off of ourselves. We promise to pay you $5,000. Okay, how can it do that, right? How can it do that? Well, one thing, it's a trusted institution and knows that people will accept its liabilities. If I write a check off that account, people will accept it. But the other part of this, right, is to think about the nature of its reserves. Is this just like having a printing press in your basement? Can banks just create money without limits? In fact, no. There's a cost to this money creation. Right? Suppose they give me $5,000, a $5,000 loan, and I spend all of that, say, buying some new computer equipment. I go to Best Buy, buy all this stuff. Best Buy deposits it into their bank. Their bank says to the Fed, hey, we got this $5,000 check from Horowitz's bank. They go to Horowitz's bank, Chase, let's say, and Chase better have $5,000 on hand to pay that off. If Chase doesn't, they've got a problem. So from the bank's perspective, it can only lend out reserves that it can afford to lose, right? If it can't afford to lose those reserves, right, then it shouldn't be lending them out. So one way to think about this are what are the costs and benefits of creating more money this way, right? Well, the benefits, right, are obvious to the bank of creating money. It gets interest on the loan. When you pay back that loan, you pay it back with interest. That's why the bank lends to you, right? So having that interest is its benefit. But what's the cost to the bank of that loan? The cost is, again, this danger of not having enough reserves on hand. When it gives you that $5,000, it better make sure that it's able to pay those back, right? So it has to weigh those benefits and costs. If you think, by the way, from the bank's perspective, then maybe the bank says, well, maybe we should create less money then, right? But that has a benefit and a cost too, right? What's the benefit of creating less money? Well, okay, less of that risk, right? You don't risk being illiquid. You don't risk running out of reserves. But what's the cost of creating less money? Well, there's an opportunity cost there of the foregone interest on the loans that you would make. So from the bank's perspective, it's constantly weighing these benefits and costs as it thinks about how much money it should lend. What banks try to do is to balance the net benefits of creating too much and too little money. Note, by the way, that when you pay back your loan, right, bank owes you fewer dollars, the bank's liabilities fall, right? And notice also, by the way, so does M1. So let me say a few things about the Fed, and then say a few things about what the Fed sort of does. Okay, the Fed is the central bank of the United States. Technically, it's private, as it's owned by the commercial banks across the country, but is for all purposes a government agency. It has a monopoly granted by Congress. Congress controls it, and even the owners, quote, owners of the Fed can't actually sell the shares. It's not like Apple or Google or something like that. The Board of Governors of the Fed is appointed by the President and confirmed by the Senate. The Board of Governors oversees the policies of the 12 district banks that comprise the system. The Fed is made up of 12 banks, each of whom is in a different city across the United States. The Fed has really several key powers. One of those is to set reserve requirements within limits set by Congress. In other words, the Fed decides what percentage of their outstanding deposits banks must hold as reserves, as deposits at the Fed or vol cash. Right now, that's roughly about 10%. The Fed also can control the total volume of reserves. As we'll see, it can create reserves and destroy reserves. And it also regulates other aspects of banks' behavior as well. And for the last 10 years, really since the Great Recession, it controls a number of other factors. Regulates banks in a number of other ways. But the Fed's main role still is money creation. Okay, and we can think about this as in three ways. We can think about three things that banks have. First of all, we can talk about a bank's total reserves. If we just add up, what do they have in their vaults? What do they have at Fed? That's their total reserves. We can talk about their required reserves, which is what are the minimum they're required to hold. Right? Roughly, again, 10% of their outstanding checking accounts. So add up all the money they owe people in checking accounts, take 10% of that. That's what they have to have on hand, either as cash in their vault or deposits at the Fed. The difference between those two, the difference between their total reserves and their required reserves, is what we call their excess reserves. So banks hold more reserves. If banks are holding more reserves than they're required to, they have excess reserves. And it's those excess reserves, right, that put a limit on how much they can lend. That's what they can afford to lose if they make a new loan to me. So what, can they loan me $5,000 if I'm a good risk? Sure. But they better have those excess reserves because I'm going to spend that $5,000. It's going to disappear into other banks, right? So you better have that $5,000 handy. If you don't have any excess reserves, if you have exactly the minimum that you need, you can't engage in any lending. Okay. So what does the Fed try to do? Well, it turns out the Fed has three tools at its disposal that it can use to try to manipulate the money supply, manipulate monetary policy. Very important thing to understand. The Fed does not really directly control the money supply. It controls reserves, which in turn affects the money supply. So the Fed has three tools at its disposal to do this. The first, we've mentioned already, is reserve requirements. Okay? The Fed can change those reserve requirements again within limits set by Congress. It could up it from 10% to 20%. And notice, if it increased those to 20%, the money supply would fall dramatically. Banks would have to call in loans. They would have to hold more in their vault cash, more at the Fed. They couldn't lend as much. Increasing the reserve requirement would be a downward effect on total reserves and a downward effect on excess reserves and a downward effect on the money supply. Lowering that reserve requirement lets banks lend more. Some countries, by the way, like Canada, for example, have no minimum reserve requirement. Banks are able to hold whatever they wish. Okay. Fed does not change the reserve requirements very often. It's simply, the effect is simply too large for them to use that in the kind of fine-tuning sort of scalpel way that they would like. A second tool the Fed has is what's known as the discount rate. This is the rate that the Fed charges banks to borrow from the Fed. They're short-term loans, okay? The lower that discount rate, if the Fed lowers the discount rate, it encourages banks to borrow from them. That means banks have more reserves, banks can lend more, the money supply is greater. Higher interest rate means less borrowing, therefore fewer reserves, lower money supply. The Fed can change the discount rate But in the end, it depends upon the willingness of banks to want to borrow from the Fed, right? If banks are short on reserves, do they want to borrow from the Fed? Do they want to borrow from other places? Because there's another place banks can borrow from, and that's they can borrow reserves from other banks. And there's a very active market where banks trade reserves. Banks with excess reserves might lend them to banks who are short. This is called the federal funds market. And the federal funds rate is the interest rate on that market. And again, the federal funds rate is the rate banks charge each other to borrow and lend reserves. Remember, the discount rate is the rate the Fed charges. The federal funds rate is the rate that banks charge each other. We're going to come back to the federal funds rate in just a minute. The third tool at the Fed's disposal is what's called open market operations. What the Fed does here is it buys and sells government bonds to add or subtract reserves. When you hear in the media people say things like the Fed is raising or lowering interest rates, what's really happening is the Fed is conducting open market operations. Crucial point to understand. The Fed does not set or control interest rates. Interest rates are set by the market, by the borrowing and lending of banks, of other people, of all kinds of institutions on the marketplace. There's not an interest rate that the Fed sets. What the Fed does try to do is target an interest rate. It has a particular interest rate it would like to see, right? It can't force people to do that, but what it can do is adjust the level of reserves. That is, adjust the amount of funds that banks have at their disposal to lend, right? And if they want, for example, to lower interest rates, they give banks more funds with which to borrow, with which to lend, rather, right? So if the Fed can give banks more reserves, banks will have those to lend. If they lend them, interest rates go down. If the Fed wants interest rates to go up, it reduces the amount of reserves that banks have. One way it does that is, again, through these open market operations. Simple version of this, the Fed goes out, buys bonds, say, from Goldman Sachs or some other bond dealer in New York City. It pays for that bond, right, by crediting that bank's, by crediting that institution with the amount of the, so if it buys a $1 million bond, right? Imagine it pays Goldman Sachs $1 million. Goldman Sachs takes the $1 million, puts it in their bank, right, in their bank account, right, and then eventually that gets credited to their bank's account at the Fed. In fact, this is all done electronically, and basically when the Fed knows who Goldman Sachs' bank is, and so when the Fed buys $1 million in bonds from Goldman Sachs, it just credits their bank's deposit account at the Fed. But notice what happens here, right? When the Fed buys those bonds, now that bank has $1 million more in reserves, right? Its deposits at the Fed have gone up. It's got $1 million more in reserves that it can use to lend out to its customers. And that lending activity, if it chooses to do it, will expand the money supply. So notice what the Fed's done here. And one more thing. That expansion of the money supply and lending activity will push interest rates down out in the marketplace. People have more to lend, right? Think about a supply curve, supply of available funds curve. It shifts to the right, interest rate falls, just like any other price. So notice the Fed doesn't control that interest rate, but it sure can affect it by the kinds of choices it makes in terms of how it uses its tools, right? And this all is reversible, right? If the Fed wants to raise interest rates, it sells off bonds, right? Goldman Sachs pays for them. How is the Fed paid for those? The Fed subtracts funds from Goldman Sachs bank's deposit account, right? That bank has less to lend. With less to lend, it's going to have to call in loans and shrink the money supply, and interest rates will rise in that process. Okay? Notice what the Fed is doing here. The Fed has the unique ability to create money out of nothing. Okay, it can create a liability off itself. How does it pay for those bonds? It writes a check off itself, basically. Right? It creates new money, new reserves to do that. When you're a central bank, that's what you can do. That's the power you have to create and destroy reserves. And those powers to create and destroy reserves affect interest rates and the money supply. And so the key here, this is the key to what the Fed does historically has done on a day-to-day basis. The Fed affects interest rates and therefore the rest of the economy, right, by its open market operations, by the buying and selling of government securities. And again, if the Fed buys securities, that is, if it pays for them by buying them from someone like Goldman Sachs, it increases the supply of reserves as banks get new deposits at the Fed. That gives them banks more to lend. They make those new loans by lowering their interest rate, moving along the demand curve. You can think of the supply curve shifting, right? As they make more loans, M1 and the money supply expand, and that has effects on the macroeconomy. If the Fed sells securities, that is, the Fed sells bonds, funds come back to the Fed. They are deducted from banks' deposits account. Banks have fewer reserves to play with to lend out. With fewer reserves to lend out, the banks have to start calling in their loans or lending less, right? Not cycling loans back out, right? As they do, interest rates rise, the money supply shrinks, okay, and we get various macroeconomic results from that. Okay, so this is complicated stuff. I understand, right? And but it's important to understand how the Fed does this. And let me make a couple of quick concluding points. Again, one key point: despite what often is reported in the media, the Fed does not set or control interest rates. What the Fed does is change the level of reserves, change the level of stuff to lend out that banks have. Banks might choose not to lend, right? And we've seen this happen in recent years. If Fed can pour reserves into the economy, banks might just choose to sit on it. They'd like to hold those reserves, especially now because since 2008, the Fed actually pays banks a very small amount of interest on their reserve holdings. And banks might say to themselves, I'd rather have this interest on reserves than the risk involved in lending out in an uncertain economy, right? The payment from the Fed is a guaranteed interest payment. In fact, we've seen that happen in the last decade, and it's been important for monetary policy. So just because the Fed leads the horse to water doesn't mean the horse is going to drink, right? The Fed can only adjust the incentives facing banks to engage in the behavior the Fed wants them to behave. The Fed does not set interest rates, and in that sense, it does not control the money supply. It influences both, but it doesn't not control them. It can't pinpoint set them. So I think that's one really, really important lesson to learn here. And the second thing to keep in mind, right, is that the reason the Fed is able to do what it does is because it has this power over the money supply. It holds a monopoly over hand-to-hand currency and over over the production of bank reserves, and it can change those at any time. And that's the key to what the Fed does. Historically, people have argued having a monopoly central bank with those powers is important because if there's a problem in the economy, it gives the central bank the tools it needs to respond, right? If we have some sort of situation where we need an emergency injection of liquidity of more money, the Fed can do it. It can create as much money, attempt to create as much money as it wants. It can just keep pouring reserves in. It doesn't guarantee it will have the effects it wants, but it can try. And so people have argued that's why you have to have a central bank. So a couple things to think about here, right? One, the same tools we give those central banks to solve problems can also be the cause of problems. If the central bank has the tools to create as much money or as many reserves and as much money as it thinks is appropriate, right, in times of crisis when we need it to do the right thing, it has the same power anytime it wants, which might generate the wrong thing. Things like inflation, for example. And there's some supplementary material on inflation that you should look at in this chapter as well. So giving the Fed the tools to put out the fire also gives it the tools to start the fire. And what we're going to see in chapter 15 is this has been a problem historically, right? That the belief that the Fed and the ability of the Fed to generate short-term economic effects by expanding the money supply has lulled people into the belief that the Fed should engage in this kind of expansion. What we'll see in chapter 15 is when the Fed engages in this sort of expansionary monetary policy, it could cause real problems and, in fact, lead to the very sorts of crisis that then, right, people say, oh, we have to have a central bank, right? So one way to think about this is that the Fed likes to pretend it's a firefighter, but it might actually be the arsonist starting the fire. We'll talk more about that in chapter 15. So again, make sure you read the supplementary material for this chapter. Take a look at all that stuff and supplementary video. There's a lot going on here. And certainly even in one of the longer video lectures I've done this semester, I can't cover it all. So please take a look at that stuff for the rest of chapter 14.